It is my privilege and honor to introduce the next speaker. So, business valuation determines the present economic value of a business using objective measures, which reflects the capacity of a business to match certain market demand, be it merger and acquisition, financial reporting, investment decisions, or taxation matters. Definitely, estimating the fair value of a business is an art. It's also a science to determine a correct commercial value, as our chairman sir was also saying. However, there are particular challenges to value a startup because it doesn't have the historical data as the mature company would have. So there are peculiar challenges to value a startup business. So to present how to value a startup, we have a subject matter expert, Mr. Naresh Tulsani, who is manager at Transaction Advisory Services at Protivity. So Naresh has over 8 years of experience in corporate finance and debt advisory. He has been responsible for preparation of investor materials like pitch books, investment memorandums, financial models, etc., as well as the technical aspect of the transaction. His area of expertise include financial modeling, startup valuations, sell-side advisory, feasible assessment, research and analysis. Logistic facilities management and the technology space. Naresh has prepared an in-depth feasibility report and financial model, conducted price benchmarking, sensitivity analysis to understand the feasibility or viability of a proposition. He has also provided a sell advisory to a prominent business group in UAE for the disbursement in an integrated logistic company and also advised a leading F&B player on raising acquisition finance and providing a valuation advisory. Currently, Naresh is involved in a potential USD valuation model deal for a company based in Switzerland and preparing a DCF valuation model, teaser and a detailed information. So it is our good fortune to have a subject matter expert on this. And let me join inviting Naresh for the startup valuation. Thank you.
Thank you so much, firstly, for welcoming me here. I'm coming for the first time to the CA chapter in Abu Dhabi. I'm a CFA charter holder by qualification, and I work at Protivity, which is a management consulting firm. I work in the transaction advisory services arm. A little bit of background. Thank you so much, Ramesh, for just calling me a subject matter expert. No, not really an expert, but as Ramesh was also mentioning, that we're all learning here, and like trying to come up with different concepts of valuation, trying and understanding how different businesses work, how do you forecast them, how do you go about valuing them on a day in, day out basis. So a lot of learning, a lot of, even Ashwath Damodaran today is still learning, and he calls himself that, I'm coming up with these new concepts. So let's proceed, and hopefully, it's a very high level sort of a session, because obviously in like 25, 30 minutes, I cannot delve deep into it, but at least I'll be able to give you some perspective of the matters in terms of startup valuation. Great, thank you. So just like a quick agenda, so we'll just give you a quick outlook of the startup funding in the MENA region. We look at the corporate life cycle and try to apply some methods of just some concepts of how one needs to look at a startup company in terms of evaluation. What are the typical characteristics of a startup company as to how do you know that this is a startup company? And we'll also look at what are the key matters pertaining to the valuation, of course, and some methodologies as well. So just before starting off, right, like what's happened is that we went through a pandemic, 2020 being a COVID year, 2019, 2020, and there we saw a lot of business losing a lot of money, right? They were not able to kind of work up to their potential. Businesses the bottom lines were falling, revenues were falling, right? But there was also a lot of opportunity, right, in the startup space. We could see that a lot of people were coming up with these new opportunities, new concepts, especially in terms of deliveries. You can just sit at the comfort of your home and enjoy deliveries, right? So you can see a lot of delivery businesses growing, food tech, right? Fintech, a lot of platforms, payment platforms coming up as well. So and that's where you see it is, right? You can see the 654 million in USD. The value of investments in MENA startup space, that kind of shot up to almost 3 billion, 2.9 billion in 2021 because of all these new fundings that were happening in the startup space. Like this is the advent of, the soft banks and the Sequoia Capital coming up with their vision funds, funding all these startups as well. So I'm talking about that sort of a space. And even the traditional investor who was just looking at real estate assets or stocks and bonds. Now just started to think about, why can't I also try and invest in the startup space? And that's why we saw a lot of traction coming in 2021 as well. And in fact, even in 2022, we can see that almost these are August numbers. We are already at 2.2 billion in the MENA space, right? And we'll see in the following slides that which countries or which countries the MENA are kind of contributing to that. So we see a lot of sovereign wealth funds as well, like for example, Mubadala and the PIF, right? They have tied up, or like they're the biggest contributors to SoftBank's Vision Fund, the first Vision Fund, and then that was fully deployed into all these startups. And now we have a Vision Fund 2 as well, right? That is kind of investing in all these spaces. So if you see fintech, e-commerce, logistics, and food tech, these are the most important, most prominent sectors that we have seen traction in the last 2 years, right? And these are all the countries in the MENA space that actually you can see in terms of deals. We kind of broke all records in 2021. So in terms of number of deals, in terms of funding rounds, we just went overboard with the 2.87 billion. So this is just a breakup of the 2.87 billion. You can see the biggest geographies, and the two most important ones are UAE, which is accounting for 50% of the 2.87 billion. So you can see that almost 50%, it's the startup hub, right? You can see a lot of companies in the UAE actually contributing a lot from their startup appetite, and hence why it's important for us to understand how these businesses work. Followed by UAE, you have KSA as well. So if you pick UAE and KSA, that's almost around 2 billion, which is around 75% of the 2.87 billion. So a lot of traction in the startup space, and hence why it's become very important for us to understand how do these companies work, to understand how valuations of these companies work, and even if you get an opportunity to invest in one, at least you'll be in the right thought process of thinking about it. So just moving on. Now, this is something very interesting by Ashwath Damodaran. I'd seen this in one of his keynote presentations. He talks about the corporate life cycle. And I think our chairman was also, like the CA chairman was also talking about it in the morning. Like, he was relating the corporate life cycle to the human cycle, right? So it's like how we age. Companies also have a certain sort of a way in which they grow, right? So when we're talking about startup companies, so we're talking about the idea or the seed stage where, you just have the idea. You just have the concept in mind, right? You just have an idea. I just laid it down. Maybe I just, on a piece of paper, I've gathered a few friends, laid down the idea, thought about it, thought about some of the expenses. It's just an idea and a seed stage. So that's the beginning of, or the baby, when the baby is born, right? That's the beginning of an idea. The second one is, again, a seed or a startup stage. You've thought about it. You commence work towards that certain idea. Maybe you have spoken to a few advisors. You start incurring a few expenses. You start getting into, developing your infrastructure, like a very, very basic infrastructure in place, just to see, okay, where can this go? The third one is more when you kind of, from a baby, you become a toddler, and now you're kind of coming into the teenager sort of a mode, where you have spent time on the idea, you have incurred the expenses, you have perhaps, started generating some revenue, like almost like, break-even types, or not even break-even. Earnings-wise, I think you will not, you would not earn earnings, but at least from a revenue-wise, you've started earning some positive monies at this stage. So that's the young growth stage. This is perhaps where your, what do you call, the companies like, let's say, Uniphonics in KSA, which is a very big communication platform, Kitopi, which is a cloud kitchen, one of the largest funded cloud kitchens in the UAE, by the way, which was funded around 400 million at this stage. So all these companies lie. And then you actually see how your ideas and actions have now started building into a potential business, a potential revenue, and you're earning money from it as well. So that's the high growth stage. This is where, your Kareem and maybe some of your companies like Zomato and all lie today at the end of the day. And then from a high growth stage, you come into a more mature sort of a growth business. This is where you kind of are enjoying your win. And you've started growing your business. You perhaps have good service lines defined, customer bases defined, target customers defined. And now you're like kind of reaping the benefits of all that you have done in the past. Finally, you kind of come into a mature or a stable stage where, and these are companies like, for example, Etisalat, you have constant customers, you have constant monies coming in, right? You have been able to defend your business from competition, but at the same time, you can see that, perhaps new people are also coming into this space because they have understood that you have done it, you have earned the monies, you know how to go about it, right? And there could also be, if you don't, let's say, reinvent yourself, then there could also be a decline stage where you can see a lot of competition coming in and kind of, competing with you, and perhaps you can see your revenues, your profits, or your share of the market kind of going down. So this is like the corporate life cycle, and an important aspect over here as well, right? So if you see the startup space or the first 4 steps, this is where our focus will be for today, where we will look at mostly like valuing companies in this sort of a space, so the first 4 steps. Because what happens is that when you're looking at a company in this sphere, the mature growth, mature stable, you already have a lot of history. You have audited financial statements, I have a good background, I can see what the company has done historically, you know, where can they go, what initiatives they have done in the past. I have a benchmark. I know that this company has earned, let's say, $15 million in a year for the last 10, 15 years. It has never crossed 15 million. So it is very easy for me to perhaps say, if you don't have any more initiatives, you will never kind of cross that number, unless and until you do something out of the blue, right? Whereas, when I'm looking at the companies here, the problem you can already see is that there is no history, there is no operations, right? I don't know what they're trying to do. It's just at a concept stage. We are all blue skying, thinking about the numbers. So it just becomes very challenging for you to just predict as to how these companies can grow, right? And the most important thing as well, and I think that was the theme here that was being spoken about as well, was the story. So when you're starting up and from left to right, in the beginning stages, the story plays a very important role, because as a startup, there's nothing, you don't have the numbers, you don't have any plan, like you just have a plan, sorry, you don't have any numbers, you don't have perhaps any existing assets that are, you know, that are giving you some value, you just have a story. So your narrative, the thought process or the founder's, the vision is what is driving the valuation. As you move from step to step, what you need to kind of do over here is that you need to focus in the seed stage or the young growth stage, you need to have your narrative, your work, your action should be in line with your narrative. So if you said that, okay, this is what I'm going to do, this is my vision, you need to make sure that your action, your vision is in line with that narrative. As you grow from a high growth to a mature growth, now it's time for reality, right? You're not only driven by the story, because you have some performance as well. And maybe what has happened is that your story was saying something else, but your performance is saying something else. So now the numbers define your story. It's not your story anymore which is defining the valuation. So yes, it is the story in a sense, but as we mature from an idea stage to a mature, stable sort of a stage, the importance or the way valuation is thought of is from a story to more like numbers, and to when you come towards the end, it's like completely based on numbers. So it's like a mix of story and numbers, but earlier it's the story, later is the numbers. So that's something that you need to keep in mind as well. Also the thought process, right? Like when I'm looking at companies at this stage, what are they doing with the money? Who are the people who are actually investing in these sort of businesses? The investors are also very different, right? Here you'll find more of like your friends and family, your founders, you know, you're starting a business, you just need some funds, you kind of reach out to them, they kind of help you out, right? So your angel investors, right, as we call it as well. And as you move along, as you have demonstrated that yes, you have the capabilities, you have the numbers, you have demonstrated some value, that's when you'll be able to attract venture capitalists and, you know, other institutions as well to kind of invest in your business and other forms of private equity. And as you mature as well, you can, you know, then you can also perhaps then go to a bank easily, get your terms and get funded as well. So that's the thought process. So the investors are also changing as we move from an idea seed stage to a mature, stable stage, right? And what are we doing with the money, right? Here, it's only about investing, correct? It's only about investing into the business. It's about building that asset base, building the infrastructure, correct? And starting off. When you come more like high growth or a mature growth sort of a range, what you can do with the money is not only about investing, but also about diversifying, getting into other aspects as well, maybe even coming up with different business models. You can think, you can be creative, and you can, you know, redefine yourselves. When you're kind of in your mature and a stable stage, what typically investors would want to do, they would want to just give back. So it's more like dividending out, you know, giving cash back to the shareholders. So just in terms of thought process, how the business has grown from an idea to a mature stage, what are the different types of investors, and how is money also thought of when you're moving from a left to a right of the chart. Does that make sense? So just because we're talking about startups, so some straightforward characteristics, right? So one of the things which I told you, there's no history, which is a very big challenge as well as to how do we then value such a business with no history. They have very small, minimal revenues, almost non-existent. All the monies are going towards establishing the business, establishing the resources, right? There's a lot of uncertainty in the business model as well. We've just started. You don't know how the market is going to react. Should I sell only to these sets of customers? Should I go B2B? Should I go B2C? How do I, structure my model in a way that I can cater to an audience, maybe, a high mid-class audience or a low-class audience or a high-class audience? So how do I do all of that? How do I tap into those markets as well? You're still redefining your models. You're still thinking through them. That's why it kind of gets challenging as well. You're a lot dependent on private equity at the same time, like, as I said, friends and family are kind of getting you the monies at first. You promise them future success. And there are different rounds that happen over here, right? You'll keep needing money because you're just a startup. You will you still have all those initiatives. You still are establishing your base. So at every point in time, the original founders who have kind of, spent the money, they get diluted at every point in time. So with every equity round, with every money raise, the original founders, the original friends and family members are getting diluted as well. So that is something to think about it from a valuations perspective as well as to what's happening in these rounds. Very liquid in nature because even in a mature company, okay, it might not be listed, but when it comes to startup, once the money is gone, you never know. It's like a sunk cost, whether it'll come back or not come back. In a mature company, if you have invested, there could still be a chance that, someone could buy you out or, or if that company gets listed, because it's already mature, the next thing could be that, it could go for an IPO and get listed and you can get some money for your stocks as well. But in a startup, it gets very, very complex when you go to investing in it, because your investment, whether it'll come back to you or not, you're not really aware. And lastly, survival, right? Like many companies don't make it past the initial idea or the seed stage, right? You can see a lot of startups coming in, but they kind of expire because they either the business model is not good or they are not getting the required funding, or it's not, many founders, angel investors are not finding it very attractive to invest in those businesses. So typical characteristics of a startup, which also kind of brings some challenges when you're thinking about valuing these startups. So just stepping back here, just thinking about valuations as a concept, and there is a lot of detail out there. You can delve into a lot of material. Today you've seen valuation models which go like 20, 30 tabs with all these different Excel sheets and Excel tabs that you can actually work through them. But what's happening is that at the end of the day, you should realize that your valuation or the business valuation is driven by some key 4 or 5 concepts, right? If these 4 or 5 concepts are making sense to you, you should be in a comfortable position to value that business. Just one second. So, if I divide my questions or key categories into a few buckets, these would be the 4 buckets that I was thinking that in terms of you can actually understand in terms of valuing your company. So, as a startup or as any business, right, there is some value in your existing assets. You would have developed something, some infrastructure, some basis of your valuation. Your existing assets, your existing business operations is giving you some value, right? Obviously, in the startup space, there's a challenge because the existing assets are still a very small proportion of the overall value of the company, right? So there's not a lot of existing assets. So when I move on, what is my second component? So that's the value added or the growth assets that I'm kind of going to invest. And this is where, as I was telling you, the growth will come from, or bulk of a young company's value comes from these sort of growth assets, right? And we also need to look at, are we just investing in these assets and we are spending the monies, but will that really add value? Will that really add to my earnings? Maybe not immediately, but potentially in the future. So that is something that also needs to be evaluated in the sense that, is this growth adding value, destroying value, or perhaps doing nothing for value? So, and how much you'll keep needing in the form of a reinvestment as well, right? So existing assets, growth assets. When I move on to the third bucket, it's like, now I have some existing assets, new assets. I have some cash flows coming out of these assets. But I want to really understand is how risky are these cash flows? At the end of the day, all of these cash flows are in the future. There is a level of risk associated with those cash flows. The riskier the cash flows, they will actually bring in less in terms of present value today. So that is something that I need to understand as well. And finally, when will my company become a mature company? Because when I'm doing some sort of a valuation, I cannot just keep forecasting cash flows, right? There will be a point that I take a stop, say that, okay, this is going to be my terminal year, and this is where I'm kind of computing my sort of a terminal value of the business, in the sense that this will be my value that will go on for perpetuity, that will go on for in perpetuity, and this is what I'm going to stop at. This is the year that I've kind of matured. Now, putting all of these in the context of a startup company, we are very small proportion here. We are a bulk proportion here. In terms of riskiness of cash flows, the company-specific risk is very high, right? So we really have to see in terms of a discount rate. We actually add a lot of elements in terms of a discount rate because we don't even know whether we are going to survive, right, as a startup company. And lastly, when will my company become a mature company? Now, typically when you're looking at mature companies, you would typically do like a 3 to 5 year sort of a projection, and you'll have a terminal year in the 5th year, because after that you're assuming that this company, let's say, is growing in line with the economy, the GDP of the economy, right? But in a startup, that's not the case, right? After 5 years, if you do a 5-year model, it doesn't mean that after 5 years, the startup will just grow sustainably at 2 or 3%. You actually need to consider the fact that, no, it's actually going to grow at a very high rate for a long period of time, followed by then, like a mature sort of a period. So that also needs to be considered when we are looking at a startup valuation. Okay, so just talking in terms of, again, the 4 stages that I was talking about earlier. You can see them on top. That's the idea, the seed startup, the young growth, and the high growth sort of a stage. And these are some of the concepts that we've already spoken about, just kind of laying them out here. So in terms of cash flows, as you see, we are more positive towards the high growth, but we are either they're not there or they're negative in the seed startup or the young growth stage. The proof of concept yet to be established, perhaps yet to be established. When you're young growth and high growth, you've already established that. Historical and projected data, obviously, it's very limited or it's not there for the seed startup stage. For young growth also, you can say that it's more or less limited, but for a high growth stage, you will still have some form of historical data that you can rely on. When it comes to, before jumping into valuation methodology, I just want to talk about the investor as well and the funding stage. You would have heard about these terms. In a startup, you have like a pre-seed, a seed funding, a Series A, Series B, Series C. These are just names of rounds. So typically when you're at the outset starting off, you call that like a pre-seed stage or an angel stage where your friends, family, or founders will kind of invest into the business. Then you have your seed stage where you will have perhaps angel investor or some more monies coming in from the founders or friends and family. And then after you have kind of established the concept and it's kind of going in line with this, you perhaps can maybe target like a venture capitalist as well who can come and fund in your Series A and beyond, right? So those are your stages and your investors, right? And when I look at the valuation now, the concept is that there are these traditional valuation methods of DCF, the discounted cash flow. We have the relative valuation or the market multiples methodology as well. But as you see, the challenge here is that I can apply these multiples not to the very early stage ones, but more to the young growth and the high growth ones. The reason again being, as we spoke about, the historical operations not being there and a lot of reliance not being there on history. But what can we still do when it comes to these two methods of valuation is that you can definitely borrow elements from the DCF or even like do a DCF by coming up with a very high level business plan for your startup company. So what we were doing is that like just last month we were valuing a startup company. There is this app that that's coming up. I cannot talk a lot about it in detail, but it's more like it's a social media app, and it has video calling, voice calling features. It has communication features, media sharing features, and all of that. It's a company in Saudi that is coming up with this app. Now, the client comes to us and he says, look, I don't have any business plan, so but I want to do a valuation. So how do we do that, right? So what we started is that we kind of did like a top-down approach, and that's something that you'll have to use to then come up with a potential business plan for that company. So how did we do that, right? So we understood that this app is targeting the Gen Z audience. So in the sense, people who are in the age of 15 years to 25 years, right? So, and we understood that this app is looking at primarily the MENA countries, okay? So what we did is that we looked at the MENA countries, we looked at what is the percentage of population within the 15 to 25 age group, right? We kind of come up with some sort of a population number. We also then go a step further to actually see how many of these people are actually into social media, right? Not everyone within 15 to 25 would be primarily into social media, though that was not the case. We almost found like 80–90% were there. So we kind of got our population sort of a number that these will be the key members or the key people. That's my target sort of an audience in terms of a number. But obviously, they're not just going to use my app, right? There are so many apps out there. There are so many other social media apps out there that people are already using. So these people that I've found out are already using 10, 20, 30 apps, right? So they're already engaged in a lot of screen time. So why will they kind of use my app? And if they use my app as well, how much portion of their time will they dedicate to my app? So doing some of these analysis, we kind of came up with some metrics, and we also compared it to the metrics of, let's say, the lead player in the market, right? And it should make sense. So whatever your story that you're putting up in your startup, it needs to make sense, right, in terms of the wider context, in the context of the market, in the context of will there be enough users actually using that app, or are we just doing an academic exercise with numbers on an Excel sheet? So after doing all of that analysis, we came up with, okay, this could be my probable revenue model, where I have all these users who are going to use my app, and I can assign some form of a metric to them, in the sense that this was an ad-based revenue model. So depending on the time they spent on the app, how many ads are they watching, and you come up with some sort of a revenue model. So basis this top-down approach, we were able to develop a business plan, right? We were able to vet it in terms of the wider context, in terms of the wider market story, because it should make sense, right? Otherwise, if I go to any investor, they'll go like, you don't know what you're talking about, because this is just numbers in an Excel sheet. You need to kind of prove it to them that this could be a potential model, a potential plan, and that kind of forms the basis, let's say, for my forecasting of my cash flows into the future. And that is where I can then do some form of a DCF and discount those cash flows to bring it to a present value and come up with a valuation. Market multiples approach, I just want to talk about it here briefly as well, because it's very difficult to apply the market multiples approach in a startup, because you don't have any earnings. You might have very negligible revenues. And even if you have revenues and earnings, they might be projected ones, maybe year 4 or year 5 or year 6. And using a market multiples method as of now, in the sense if I'm looking at the last 12 months of multiples, or if I'm even looking at the next 12 months of projected multiples, then taking them and applying it to my year 4 or year 5 projection might not be the most appropriate. It can be challenged, it can be contested, and it might not give you the result that perhaps you're looking for. So what are the 3 methods that then you can actually use when we're looking at a startup, right? And the third one, which is the VC method, is a very, very popular method that you would have looked at, and that's how you see all of these companies being valued as well, through the VC method. It's very intuitive, and that's why I think maybe people just understand it very easily, and that's why it's very, very popular. So just going to spend a couple of minutes over there as well. So if you look at the cost approach and the scorecard approach, now these are very straightforward approaches. Cost approach is nothing but, okay, when you're looking at your idea stage or seed stage, what is the money that you have invested so far into the business? That is one metric, right? So this client that we were speaking to, again, the startup guy, right? So he said, I've invested roughly $500,000 into the business so far. I've started 7 months back, and I've invested $500,000. So that is one approach, right? You can see, okay, that is the literal physical monies that have gone into the business. So that is one metric of valuation in a way. That's the cost approach, right? Whatever OPEX, operating expenses, capital expenditures you have incurred so far, that becomes some form of value. But obviously there's a huge drawback to this approach, because I have invested all this money so that I can generate revenues in the future, right? So this is not telling me your potential valuation, because it's just giving me my cost estimate, cost numbers so far, and I'm combining it at a valuation. But that is an approach, a very quick and dirty approach that people actually use to come up with some sort of a valuation, like what have you invested so far. The other one is what we call the scorecard valuation method. So what happens is that this is some sort of a benchmarking method, because what you do is that you have a startup which you cannot value, but you know that what industry it is in. You know that what's the management team behind that startup. You know how many employees are running in the firm in that startup. You know the product, you know the technology, because you've done some analysis, you can see some sort of a market. So you come up with some of these metrics, right? You come up with like, what is the management team strength? What is the product or the offering? What is the competition? What has been the sales so far, if any? What is the additional investment required? How big can this grow, right? And then you do some sort of a weights. You do some sort of a weight allocation to them to come up with a scorecard. And what do you weigh, right? So you got some of these weights, but then you need some number to actually apply these weights to, so that you can come up with your valuation. So for that, what happens is that you kind of look at the average pre-money valuation for pre-revenue startups similar to yours. So it's just a glorified version of saying I'm just doing some form of benchmarking, but I'm more focused in terms of looking at companies like me at my stage, maybe in different geographies, in different regions, and kind of then doing some sort of a weighted average analysis to come up with my pre-money sort of evaluation. So that is, again, an approach, but again, there are some drawbacks to it, because these weights can be very subjective. Pre-money valuation average also may not be accurate. You never know what you're taking, or what those pre-money valuation, how have those been derived. You don't know, right? So there's a lot of non-clarity when it comes to this method as well. So let's talk about the most popular method, right? And a very intuitive method that companies really like. Venture capitalists really like this, hence the name, venture capital method. And it also has a few drawbacks, but we'll talk about that. But at least it's a very straightforward method to understand. So the first step is that you estimate what is the investment that your startup would require. That's a very easy number, right? You know you can just ask a founder, okay, what money do you need at this point, right? How much do you need for the next 12 months, for the next 18 months? What is your, you have some vision, you have some thought process. What are you going to burn? So you come up with that number, right? And then you forecast your startup revenue. So now this forecasting exercise is, again, as I told you, through the top-down approach that we were just speaking about. So you forecast it to a point typically when, let's say, a venture capitalist plans to sell or exit this business, right? So let's just, for example, over here, I've just put like these 5 years. You have 0.5, 5 million, 10, 25, 40. This is what the founder is anticipating in terms of a revenue profile. But however, you have kind of vetted it by doing your top-down analysis, trying to see, okay, whether these numbers are achievable, the same thing that we were talking about, right? The user base and the growth metrics. So you come up with this sort of a number, and the startup is expected to grow at 40 million in sales in year 5. And you determine the timing of exit, which is 5th year. In this case, the venture capital says, okay, I'm going to invest now, I'm going to stay 5 years in this business, and I'm going to exit in year 5. And then you kind of come up with an exit multiple. Now, how do you come up with this exit multiple? You can look at, again, basis market benchmarks, similar companies, how have they been valued at in terms of revenue, because we are looking at revenue numbers here. And even recent transactions, if any, how have they been valued at, again. Again, a lot of contest, we get a lot of, contest, we get contested here in the sense that you're looking at these exit multiples either last 12 months or next 12 months, and you're going to apply it after 5 years. Is that always the right way to look at things? Yes, no. So there's definitely a contention that, but still a very popular method and people use it. So you apply that exit multiple to your valuation. So 40 million into 5, that's the 200. And the venture capitalist will then kind of come up with their target rate of return, that I want to earn at least 50% in terms of my return when I'm doing this investment, right? So if I discount that value, so if you see, I'm standing at year 5, 40 million in revenues, I do a 5x, I come to a 200 million, that valuation is the valuation in year 5. Now I kind of discount those to present value to come to almost a year 0. I discount it by 5 years at 50% to come up to a roughly an indicative valuation, a post-money valuation of 26 million. Why do I say post-money? Because this revenue stream can only be achieved if the venture capitalist invests the 6 million. So these cash flows or these revenues are only coming out of the venture capitalist's investment. Hence, the valuation that is coming out of it is a post-money valuation, right? So if I look at it, the post-money valuation is 26 million. The capital invested by the venture capitalist is 6 million, so his ownership stake is 6 over 26, that's 23%. And if I were to just look at a pre-money valuation, it's nothing but 26 minus 6. Like, what is the valuation without the money being invested? So a very popular method, a very intuitive method, a method very popularly used by a lot of venture capitalists. And what happens is that when you look at some of these metrics, because a lot is written on this method, you actually have all these valuation gurus, like you can see Damodaran as well, who actually say what would be your target rate of return if you're valuing like a idea seed startup, if you're valuing a startup, an early growth, or an expansion. So as you see that, as you're growing into stage by stage, you can actually see that the target rate of return comes down because you kind of get more confidence in the business. You see that, okay, this business has that chance of survival. At an early stage, you don't even know whether this business will survive, right? That's why your discount rate is the highest. But at a later stage, you kind of factor in that risk that, okay, now it's getting less riskier, and hence I get less return for it as well, right? More risk, more return, less risk, less return. But the drawbacks, so as I said, right, one of the drawbacks that we are focusing on multiples of these revenues or earnings without giving thought to any other matters. So what happens is that because venture capitalists are very like this method, it just encourages gameplay. You come up with some sort of a multiple, exit multiple, you come up with a valuation, right? As an investor, you would want the multiples to be the highest, the discount rate to be the lowest. The venture capitalist would want the multiple to be the lowest, the discount rate to be the highest, and there, as Ramesh was also talking about, it's always like a back and forth in terms of, okay, this is what the value is, that is what the value is, and you kind of come and get confirmation in some sort of a mid-ground. Looking through the multiples now and then applying them to the future, that's another drawback as well. this target rate of return might not be the exact rate. Like, okay, this is, we're saying, Damodaran is saying 50 to 70%, but you know, there are things like, for example, if you have, I know that you cannot borrow debt at a very early stage, but if there is some form of debt in your cost of, in your capital, then how do you account for that cost of debt as well? That is, ideally, when you say that, you know, you've used debt and equity, the weighted average cost of capital becomes your discount rate that you should use to, you know, discount the businesses. So all of that is not coming into this venture capital method as well. And this new capital infusion that is coming through, sometimes it's not always put into the business, as Ramesh was saying as well, right? Like, money can directly go, you know, the seller at this point might take some advantage to take some money off the business as well and into their pockets. Then that pre-money, post-money valuation will need to be re-looked at as well. So some flaws in this method, and I think that that's what the nature of the, you know, method is, but at least it's still a very popular method, gives you some thumb rules to start off and negotiate your valuation. So as we always say, right, this is my concluding slide, and just want to like come up with the key messages. So we understand that with young companies, yes, you can value them, but there are definitely a lot of challenges when it comes to looking at young companies in terms of their history, right? No history, operating losses, the possibility of the probability of a very high failure, and hence why we face all of these challenges when valuing them, right? You can use your DCF methods or the market multiple methods as well, but you'll need to kind of tweak and adjust them in the sense that you might have to go with a very high discount rate, or your terminal value. Is that your true terminal value at the end of year 5? No, perhaps you might have to extend your cash flows to show a very high growth rate period for a young company, and then you kind of, you know, show a smaller growth rate period as well. So that is another thing that you have to think about when using conventional, traditional models of valuation. Market multiples, yes, no, could be applied, cannot be applied. VC method, which has gained popularity, can be applied, right? And today, like when you look at it, right, at the end of the day, you have access to innumerable data. You actually, it's perhaps not a very good thing when it comes to valuing companies, because nowadays, as I was telling you in the beginning as well, you have spreadsheets, loads and loads of tabs, multiple people kind of giving different views and stuff. So sometimes you get too bogged down into the details, you kind of lose sight of the big picture. So it's always important to just take a step back and see what are the 4 or 5 key matters into this business that I need to kind of look at when I'm valuing it, right? It's the existing cash flows or the existing assets, the money coming in from the existing assets. It's the growth assets, what are they helping me contribute? How risky are my cash flows, and when is my business going to mature? So if I just have these 4 or 5 key matters in place, you don't actually need to dwell into the details of the tabs and the valuations and stuff. You can just look at a projection and say whether it's making sense to you or not. So that's a very high level run through, and I'm also being mindful of time. So if you have any questions, happy to take them, or else we can even discuss them offline. But thank you so much.
8 years ago when Facebook first bought WhatsApp and paid 18 million or 16 million, they took it to the second 2 digits. And at that time we were wondering what they were going to do with the data. How do you value something like data? And more recently, like last week, Figma was purchased by Adobe and it was 20 billion. So who comes up with these valuations, and what, it doesn't fit into our bean counter approach. Exactly. Yeah? So who's coming up with, how are they coming up with?
So actually that's the point, right? Like when they are kind of coming up with these crazy numbers and crazy valuations, and you're always looking like, you know, where you're having these multiple rounds, 1 billion, then 5 billion, then 15 billion, 20 billion, right? Facebook bought WhatsApp at 19 billion. Your Zomato Middle East was sold to Delivery Hero for about 172 million. And your Uber buying Kareem for 3 billion. So these crazy numbers, how they are coming up with is, again, I think some sort of a top-down approach. They have to run some sort of a numbers. It cannot be that they are not predicting any sort of cash flows. There are definitely cash flows in play here. There is some sort of an analysis that is being done in some form of projections. Even like when you're looking at, you know, like WhatsApp. So WhatsApp did not have WhatsApp for Business earlier, right? So WhatsApp for Business is now like it's a paid setting as well. You need to kind of get some form of a subscription and kind of get onto the platform as well. So I'm trying to tell you that they come up with different business models, different revenue streams, and because of the scale of the technology, everyone is using it. It's very easy for them to just show that a revenue grows from a 10 million to a 200 million in 1 year. Right? That scale is achieved very easily, very quickly, especially for technology companies as well, right? So a manufacturing company like GE will take 40 years or 50 years to get there because it has to go through the entire cycle, the idea, the startup, the seed that we were looking at the beginning, the young, the high growth as well. But for a technology company or for a software company, it could be very quick now. It could, that entire 50-year timeline may just be about 7 years or 8 years, and they could achieve their potential, right? So that's how they kind of are able to come up with those excessive valuations because they're not looking at a very, very long sort of a growth period as well. Like even the business that I'm valuing as of now, that we were doing for this startup, we were looking at like a growth period of about in 10 years, and it would achieve, let's say, X valuation, which is again some sort of a crazy number, if that answers your question to some extent. Yes.
Hi Naresh, thank you so much for such a knowledgeable presentation. I have two questions related to the startup scene in UAE, and it's more related to the funding side, what you showed there. So, you know, the last few years have been great for startups, the founders being backed by a lot of investment funds and startup funds. But recently there's a new thing which is happening is the funding winter, where a lot of startup funds have started to be cautious about spending money on the startups. So how do you think this is going to impact the UAE startup scene in the near future? And second thing is, a lot of the startups which has become unicorn, large global success, has come from markets like US, India, where there's a large addressable markets, large population to cater to. But UAE being such a small market, there's a small population to cater to. How do you see the success of startup scenes in the specific?
So you know, like you're absolutely right. You know, like UAE was not very, very much into startups back in 18, 19. But after this pandemic, and as I was showing you as well in the beginning, you know, you could see those insights that a lot of companies are now looking at it. Even traditional investors and funds and sovereign wealth funds like ADQ has now coming up with these startup funds, 100 million, 200 million, just dedicated for startups, just looking at companies which are actually trying to do something different, trying to, you know, coming up with a different concept, and they're supporting them, encouraging them to grow, to develop, you know, to come up with all those creative business models as well. Because that's where creativity happens. You need to have a startup culture for people to think innovatively, for people to kind of add value and, you know, bring out the best in them, because that's where creativity happens, right? You have a mature business, it's just going on, you might just make a few tweaks, a few reinventions, and, you know, you can go ahead. But your true creativity, all of that kind of happens at the startup stage. And UAE is now definitely focused a lot more on it. As you can see, a lot of these sovereign wealth funds and other investors kind of focusing on the startup space, dedicating funds to that. You already can see that in ADQ, in Mubadala as well, and these other players, if that answers your question.
Startup is a term which always evokes some kind of curiosity in you.
Yes.
But I'm sure, valuations, approach on valuations that you mentioned has been new to many of us.
Yes.
As a token of appreciation, we would like to present a memento, and I would like to invite Rohit Dayma, our General Secretary.
Thank you. I would
CA
actually like to also tell you guys, you know, like it's so when this opportunity came to me of coming into and presenting to you guys, so I was asking my MD, okay, happy to do this. When is it happening? So he told me that it's happening on a Saturday, and I was like, okay, that's fine. I can come in. That's no problems at all. He told me it's in Abu Dhabi, and I was like, okay, that's no problems at all. I was like, what day it is? Like he told me it's on the 24th of September. I'm like, okay, and actually I told him that, you know, it's my birthday today, and, you know, I'll be
Happy birthday.
coming to the CA Abu Dhabi chapter on my birthday and delivering this. So it's a different way of celebrating a birthday as well. So thank you so much for having me here, and I hope I was able to, you know, add some value to your thoughts.
Thank you very much. And once again, on behalf of all of us, happy birthday to you.
Thank you.
So, Rohit Dayma, CA Neeraj Rutolia, and now CA Senior Member, CA Moni.